Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Wednesday, November 12th, and kind of a mixed bag in the agricultural space. Grains higher and livestock mostly lower. Over in the outside markets, a little bit of volatility in the indices flying around, with the Dow ripping higher and some of the other indices like the NASDAQ and S&P seeing a little bit of pressure. And then the precious metals, gold and silver, on the move again, with silver taking the charge there. Before we get into the charts, we'll go over some of today's closing prices in the grain and livestock markets today. December corn futures, 3 1/4 cents higher, 4.35 1/4 was the settlement there. January soybeans, 6 1/2 cents higher, 11.33 3/4. And December Chicago wheat futures sharply unchanged at 5.36. You may look at that price action and say kind of a ho-hum day. If you zoom out and look where we started on the day and look at the intraday chart, it was actually very, very impressive. Overnight trade session, we saw a little bit of weakness, a little bit of a choppy trade. And then on the 8:30 open, where we get more participation, that's really when the market started to bottom out. And then from then, markets grinded back higher and finished near the upper end of the range. So a low range open and a high range close is very constructive for the charts. However, we do have a WASDE report on Friday, so whether or not that's going to throw a wrench in things, to be determined. But if we didn't have that and you're just looking at the technicals, this price action is what you want to see if you're bullish. We're knocking on the door of a technical breakout for corn and soybeans, as we've talked about here recently. We've got 535, 537 as the upper end of that range. 200-day moving average also comes in right there. If we're able to see consecutive closes out above there, I wouldn't be surprised to see that kind of feed on itself and add some additional technical momentum here in the near future. Now, with that said, a failure at the top end of the range probably just drops us back towards the lower end of the range, and that 20-day moving average, which today comes in at 428.5. Still think we can kind of stair step higher in the corn market. I don't know that it's going to be a runaway trade, but I think we can continue to mark higher lows followed by higher highs. Now, over on the soybean chart, a similar setup here. We're at the upper end of the range. 11.37 was the recent highs. If we're able to get out above there, I think that opens the door. There's really not a whole lot of technical resistance, so a lot of air on the chart above there that could quickly propel this market towards 11.45, 11.50, which is more of a psychological level than a technical level, with the market essentially in uncharted territory here. A lot of this is just momentum based. And I know a lot of people have been talking about, well, if China's not really buying any beans, why is the market higher? The market's telling us that something's going on. Either China's going to come to the market and probably make some purchases, or there's bigger concerns out of South America. Regardless, price is king here, and the price has been very, very strong. Usually when you get these type of headlines, it's a flash in the pan and short-lived, but we've been able to retain the recent strength incredibly well over the last 2 weeks, and to me that speaks volumes. What you're going to want to keep a close eye on, though, is this 11.12, 11.10 area. If we cannot defend that on a closing basis this week and we close back below there, I think that would probably flip the script and be a little bit more bearish going forward. So some big technical levels in a big week with the first WASDE report since September. The average analyst estimate for the corn yield comes in at 184 bushels per acre. That would be down from 186.7 in September. And then for soybeans, the average analyst estimate, 53.1 bushels. That would be down just 0.4 of a bushel from that September report. I think we get a knee-jerk trade reaction on the back of this report. Then I think we quickly turn the page over to trade, global trade, with China and other countries, as well as South American weather developments. Now, we do have a South American dashboard on our website that we're updating throughout each week with weather updates, currency updates, etc. So if you've not gotten access to that portal, head over to bluelinefutures.com and get signed up for that. And lastly, we'll touch on wheat. It's kind of been a dog all week. 535, 533 area has been the pivot pocket. This is old resistance in September and August, and then where we broke out of here recently at the start of November. Now we're back here and just kind of treading water right there. The fact that we're able to close off today's lows were constructive, but again, I think that was probably more so spillover strength from corn and soybeans. If corn and soybeans soften up, I think wheat probably craters as well. We do have some support coming in at the 20-day moving average and these recent lows that coincides all with each other near 525. So If you want to be long this market and optimistic on the wheat market, you need to defend 525, a break and close below there, and that's where you know you're wrong, where you just rip the Band-Aid off and move to the sidelines. Now, we'll jump over to the livestock markets. December live cattle futures got into this consolidation zone that we were in at the end of October and start of November, and really couldn't get any more momentum here over the last two sessions, which we warned about in our daily livestock roundup. This consolidation zone so far is marking a lower high, and that does not look great on the chart. As you can see, since these highs in the middle of October, we've marked lower highs and lower lows. Failure to get back out above the upper end of this consolidation zone near 232, I think, keeps the bears in control of the technical landscape. Now, does that mean we're going to see continued pressure like we've seen over the last month? No, not necessarily, but I think it's a big technical headwind for the market, especially with the potential for additional headlines coming from the administration that are largely unpredictable and impossible to time for that matter. Now, on the feeder cattle chart, similar type of setup. You got into this consolidation zone from the end of October, start of November, marked a lower high and really couldn't get anything going there. So, again, I think rallies are probably opportunities for those who need to look for downside protection to get downside protection. Potentially, we get out above some of these levels. If cash continues to strengthen or can continue to strengthen, we can go fill these gaps. But I think it's going to be very, very tough to get out above there with some conviction going forward. Now, over on the lean hog side of things, we had a good couple days in this April contract, and then today gave some of that back to the 50% retracement, or basically the middle of the trading range from this year. I think 85 and a half represents fairly decent value from a risk-reward perspective. A break and close below 85, rip the Band-Aid off and reset there. But again, I think a risk-reward setup is there for the buy side with how heavily sold it's been over the last couple of months. Now, over on the crude oil, we'll touch on that real quick. It was looking like a potential breakout yesterday with a bull flag coming into play. Today, a big rejection on some bearish fundamental headlines with regards to global production and the United States production as well. So that really dropped the hammer, and now we're closing below the recent lows, which opens the door for some more downside potential. I think oil longer term can possibly be a canary in the coal mine and maybe be a good trade longer term, but today's price action certainly tough to get over. I do like having some sort of long exposure on crude oil for a longer term play, but again, keep that position sizing relatively tight. And lastly, just look at the silver chart, just ripping higher today, on the verge of breaking out above those October highs near 53.70, 54. So a couple markets there on the outside world to keep your eyes on. If you have any questions at all about any of them, do not hesitate to reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.